All right, in this session, we will discuss the audit risk question, right? And it is the question from September, December 2021 exam. So here is the scenario. It is 1st July, right? It is 1st July 2005. We are a manager in the audit department of McLean and Co, a firm of chartered certified accountants. You are assigned uh, to the audit of Uber company, which has a financial year ending 30th September 2000 X5. So first thing to know that it is the 1st July. Okay. So it is 1st July and 2000 X5, and you are the manager in the audit department of McLean and Co, a firm of chartered certified accountants. You are assigned to the audit of Uber company, which has a financial year ending 30th September 2000 X5. Okay. Gruber Company is a new audit client of McLean and Co, firm of audit, having been appointed in January 2005. The audit was previously performed by Elise Associates. Okay, it's a new client, and previously it was performed by Elise Associates. Gruber Company is owned and managed by the Gruber family. It is principal operations being the design and construction of bespoke machinery used in oil industry. Right now we have 5 exhibits, and directly we will move to the first exhibit now. Look at it. So first exhibit, here it is, the partner email, and what is saying: to audit manager from a Powell audit engagement partner, subject audit planning for Uber company, date 1st July 2005. And now it's saying, hello, I have provided you with some information which you should use to help you planning the audit of Uber company for the financial year ending to 30th September X5. As you know, Uber company is a new client, and the firm client due diligence know your client, and acceptance procedures were successfully completed. Now, I require you to prepare the briefing notes for my own use, in which you discuss the matter specific to the planning of an initial audit engagement, which should be used, considered in developing audit strategy for Uber company. As you know, you do not need to discuss matters relating to whether it was appropriate for McLean and Co to accept Uber company as an audit client, as acceptance is confirmed 6 marks. Right. This adding or this requirement is not a routine one, so we will look at it in some later stage. In this session, what we will do, we will look at this requirement using the information in Exhibit 1, 2, 3, and 4. Evaluate the significant audit risk to be considered in planning the company audit. And what we will get 24 months, right? So moving ahead. We will look at this exhibit later on. Now what we will do, open it, and now we open our answer sheet, and now we will write the starting the introductory part. To start the introductory part, what we'll say, these are our briefing notes, right? So briefing notes. Now to audit engagement partner from audit manager, subject Uber company audit planning. Firstly, we need to give the introduction. And introduction, what we will say, These briefing notes includes discussion on the implications of being an initial audit engagement and then move on to of evaluation audit risks. The notes also recommend the audit procedures on investment property. Finally, the notes address the ethical issues arising from a meeting with the company's management team. So far, so good. Now, firstly, we are skipping the first requirement in this session. We'll be looking at the audit risk. So my heading is audit risk. First risk is new audit line, as we just highlighted, right? So what we'll say, this is the first year. In which McLean and company has audited the company, which increases detection risk as our firm does not have experience with the client, making it more difficult to detect material misstatements. Also, there is a risk that opening balances, comparative information may not be correct as the prior year figures were not audited by the McLean and Company. And therefore, we should plan to audit the opening balances carefully. Further, what we'll say, McLean and Company will need to communicate with these associates to arrange to review their files identify any potential issues with prior audits. In particular, McLean and Co. will need to investigate in detail the reasons why the former auditors resigned from the assignment. Right? So far, so good. Now, from the part we have another point to discuss, that is management bias. Right? Now, how it can happen? Let me explain. These both are the detection risk. New audit line, detection risk. Management bias, detection risk, and we are getting 2 marks per risk. So overall, 2 marks has been scored. Now we are moving towards the 4th mark, and the company's major shareholder, whoever will say the company's shareholders, Martin Gruber is planning to sell his shares in the company, and initial discussion have already taken place with a potential chaser. This situation means that uh, management by there is a risk of management bias. The risk of management bias in that Martin will want to maximize the sale price, and for this reason there is a risk that assets there is a risk that assets will be overstated. Assets will be overstated, and revenue and profitability maximize as we will want the company financial statements to reflect a good of financial position and performance possible. So far, so good. We are done with the two risk and we have scored uh, 4 marks. Now we will move to this scenario to find out another risk. So what will say the company was established 15 years ago. Martin Brucken, an engineer who patented a new type of machine used in the oil industry. Martin, who is a company CEO, 60% of shares in the company with the remainder split equity between his brother and sister Craig and Iris Group. The company board of directors include Craig Cooper as a CFO, Aries Gruber as marketing director, and a non-family member, Kelly Hayes, who is director of operations. Gruber company has 300 employees, most of whom are mechanical engineers. Martin is planning to sell the shares and retire from the business. Craig and Aries, who are younger than Martin, will retain their shares and their board position. Initial discussion with the potential acquirer for Martin shares began last month. The company owns a head office and leases a production facility where machines are designed and assembled under contract with individual customers. Typically, an order takes 14 months to complete from the initial design to installation at customers' premises. This is due to large size of the machinery being produced to customer order and the very specific requirements of customers. Okay. Then we are done with this part. Though, as you can see over here, first part from the second exhibit, management bias, already covered, right? In which I just said the company major shareholders, Martin Gruber, is planning to sell his shares in the company, and initial discussion have already taken place with the potential purchaser. This situation means there is a risk of management bias. Now, in that Martin will want to maximize the sale price, and for this reason, there is a risk that assets will be overstated and revenue and profitability maximized, as he will want the company financial statements to reflect a good financial position as much as possible. Right now, let us look at the projections over here. Revenue, as you can see, projected revenue 75 million, whereas actual was 65 million. That is, let me see how much is that. 10 It's 15%. See, it's 15% and 15% rate. It's material. Operating profit is how much? 8 divided by 10. It's 8% greater, so it's also material. PBT also material. Now, revenues derived from contracts involving the design, manufacture, and installation of machinery to customer order. Currently, the company establishes all of its customer contracts to contain any one performance obligation, the successful installation of the machine at the customer premises. However, around a quarter of the contracts also include a 3-year support service for the machinery installed. Moving down for the further contract scenario. Here it is. In October 2004, Gruber Company entered into a significant contract to design and construct and install a large piece of machinery for a new customer, Argyle Company, in October X4. It was established that the design and construction of the machine would take 15 months, with installation estimated to have place in January X6. The agreed price of the machinery is 6 million, and Gruber Company will have incurred cost of 2.6 million in relation to this contract by September X5. Based on the project plans, the estimation value of the work certified at 30th September X5 is 4 million, and the estimated cost of the complete is 1.2 million as noted in Exhibit 3. Operating profit includes the profit of 2.2 million relating to Argyle contract. Johnson contract on 1st December at 4. Google company entered into a contract with Johnson company to design and construct and install a machine. The contract will take place of 12 months to complete. Was initially protected to make profit of 2.8 million. However, due to cost inflation and errors made in the initial project budget, the contract is now estimated to make a loss of 840,000. Okay. And in 2000 X4, October X4, following the completion of a significant contract, the company purchased an investment property, the Nakatomi building, for 15 million. The property is a rental development. Okay. In the country's capital city, the company is going to appoint an expert, provide a valuation of the property, and initial estimate of the increase in fair value of 2 million has been included in the company's financial projections to 30th September X3. Now we already look at the above point. Firstly, let us write related to the revenue now. Okay, after management buys, first we'll discuss about the analytical procedures briefly. And what we'll say analytical procedures. Overstatement of revenue, profit. So revenue is projected to increase by, calculated already, 15.4%. Operating profit is projected to increase by 80%. PBT, that is profit before tax. In short, what I will say, PBT is projected to increase by 55.6%. Okay. So what we'll say, there may be relevant and appropriate explanations for these trends. The auditor should be alert to the possibility that revenue and profit could be deliberately overstated. What we can say further? We can say further that the trend in operating profit is particularly concerning and management will need to provide explanations and corroboratory evidence in support of these projections. Martin Gruber as incentive for the financial statements to show growth and revenue and profit given the potential sale of his shares. So there is a risk of aggressive earnings and earnings management. Okay. Now move to the question again. Revenues derived from the contract involving the design, manufacture, and installing of machinery to customer order. Currently, the company established all of its customer contracts to contain only one performance obligation, the successful obligation. Now let us discuss about it now. Recognition of revenue. Support service. On this, what we'll say that company sells around 1/4 of its machines under a contract which includes a support service, but all contracts are not, but all are currently being established with only one performance obligation. There is a risk that the revenue stated related to these contracts is not being separated into component as parts required by IFRS 15. Now we have to discuss the concept of IFRS 15 as well. So we will explain the IFRS 15 by saying that IFRS 15 requires that when accounting for revenue, performance obligations in the contract are identified, and where a contract has multiple performance obligations, revenue should be allocated. To performance obligations. in the contract by reference to their relative stand alone selling price. Now, what we'll say, we'll say that there is a risk that Uber company is not disaggregating a contract revenue between the obligation relating to the supply and installation of the machine. And the provision of the support service. Next, we will move to the next risk, that is recognition of revenue of profit of by company. We read the first one in the in exhibit 4, maybe you remember. Now what we'll say in it, we'll say that the CFO suggestion that the full amount of profit can be recognized this year in respect of this contract is incorrect. Now what we'll say, when performing long-term contracts, IFRS 15 states that appropriate methods of measuring progress, appropriate method of measuring progress towards the satisfaction of a performance obligation that is the completion of the contract include output methods which are based on with determining the stage of completion of the performance obligation by reference to the value to the customer goods or services transferred to date relative to the remaining goods or services promised under the contract. Or on the basis of the entity efforts, or you can say inputs to the satisfaction of performance obligation. Oh, sorry, right. Now, what we'll say further? It's not over yet. And it will say further that based on the company's accounting policy, which is to use the output method, the stage of completion should be based on work satisfied, which is projected to be $4 million compared with the contract price of $6 million, giving a percentage completion of 66.7%. The company should therefore recognize (66.7%) of the estimated 2.2 million profit on the contract, which is 1.47 million. Therefore, profit is overstated by $730,000. This is material at 5.2% of profit before tax. In short, we'll say PBT. The accounting treatment could be an indication. of management bias and the desire of Martin Gruber to overstate profit for the year. Now, so far so good. I hope it's clear till here. So for how many marks we get? Let us look at out of 24. New audit client, we get 2 marks. Congrats. Then for the management bias scenario, we got 2 marks. 4 marks over here. For analytical procedures for calculating it and then commenting on it, we get 5 marks for it. So 2 and 2 and 5 is 9 marks. Great. Recognition of revenue here, as it includes materiality. It's just the treatment and the conclusion. So 2 marks, so 11. And then for Argyle company, it's materiality, explanation, and conclusion, 3 marks. So overall 14 marks we get out of 24. 10 marks to go, by the way. So now next heading was in exhibit 4 was Johnson Company, which was our onerous contract. The projected profit to the projected profit to 30th September 2005 includes a loss relating to the Johnson contract. It is correct that the losses should be recognized. However, the method applied recognizing the loss over time is not appropriate. The total loss on the contract estimated at $840,000 is material, as it represents 6% of PBT, profit before tax, where contracts are expected to be loss making. They should be accounted for as onerous contract according to IS 37. IS 37 requires a provision to be recognized for an onerous contract. A provision should be recognized for an onerous contract onerous contract, and an onerous contract is an contract in which the unavoidable costs of meeting the obligations under the contract exceed the economic benefits expected to be received. So IS 37 states a provision should be measured based on the unavoidable cost of fulfilling the contractual obligations from the information provided it is not possible to determine the exact amount which should be provided, but recognizing the loss over time is not an appropriate method of accounting, and it is likely, sorry, likely that the loss recognized and provision in SOFP statement of financial position are understated. This could be sign of management bias, accounting treatment applied reduces the loss recognized within profit for the year and could be indication of earnings management applied in preparation of financial statements. So far, we get 17 marks by covering it till here. Now, moving ahead, next one was related to the investment property. So what we'll say, the 15 million invested in Nakatomi building is material as it is 12.5% of total assets. Okay, the change in fair value is also material as it represents 14.3% of PBT. Right. So far, so good. It is appropriate that property is measured at fair value and that the gain is recognized in, within profit. This is in accordance with IAS 40. Which permits, okay,